Welcome to Finance Deep Dive. Today, we're going to unpack the Federal Reserve's most critical and honestly most controversial decisions of the last 20 years. We're talking about choices that have completely reshaped our economy and, whether you realize it or not, have had a direct impact on all of our wallets.
So let's just dive right in with a massive question that economists are grappling with right now. Looking back at everything we've all just lived through, did we just witness one of the biggest policy mistakes in modern history? It's a bold claim, but when you start looking at the data, the case for it is, well, it's pretty compelling.
And at the very heart of this story is one single number, 9%. That's how high U.S. inflation peaked back in 2022. Think about that. A staggering 40-year high. It just completely eroded the savings of millions and really set the stage for a pretty painful economic whiplash.
All right, Section 1, Seeds of Crisis, the measured pace to the Great Recession. So to really get how we ended up at 9%, we actually have to rewind the clock, way back to the mid-2000s. Now, on the surface, everything seemed pretty stable, right? But underneath it all, the policy decisions being made back then were planting the seeds for the huge financial crisis that was just around the corner in 2008.
Okay, so after keeping interest rates super low, the Fed decided to start tightening things up in 2004. But here's the key. They did it at what they called a measured pace. So think small, predictable, almost tiptoeing steps. And the problem, as critics now point out, is that this super slow, gradual approach meant money stayed cheap for way too long. And what did that do? It helped inflate that massive housing bubble. By the time they finally stopped hiking rates in mid-2006, it was already too late. The damage was basically baked into the system.
Now look, to be fair, when that crisis finally did hit, the Fed's response was, well, it was absolutely unprecedented. They acted so forcefully that a lot of people, like Alan Meltzer from the Hoover Institution, give them credit for preventing a complete and total meltdown of the financial system. But, and this is a big but, that very response kicked off a whole new era of economic policy.
So with interest rates already slammed down to zero, the Fed was pretty much out of its usual tricks. They're out of traditional ammunition. So what do? They turned to this powerful and pretty controversial new tool, quantitative easing, or as you've probably heard it, QE. In simple terms, it's like the Fed digitally printing money to buy up huge amounts of bonds. They're just pumping cash directly into the financial system to try and get the economy moving again.
And wow, this chart really just shows you the sheer scale of that intervention. Just look at these numbers. Before 2008, the Fed's balance sheet was less than $1 trillion. Totally normal. By 2014, after all that QE, it had ballooned to $4.5 trillion. And then, after the COVID response, it nearly doubled again, peaking at almost $9 trillion. That is a nearly tenfold increase from where we started. Just incredible.
Section 2, the biggest miscalculation, transitory inflation and the 2021 delay. So all of that really sets the stage for the main event of our story today, that post-COVID inflation surge we all felt. And the Fed's handling of this period? Well, it's what a lot of experts are now calling one of the biggest policy miscalculations in its entire history.
So picture this, it's 2021. Prices are starting to surge everywhere. You've got a mix of massive government spending and totally tangled up supply chains. And the Fed's official line? Don't worry, this is all just transitory. But as so many people are pointing out now, calling it temporary while the money supply was just exploding, well, that turned out to be a massive miscalculation. But the data? Yeah, the data was telling a completely different story. Inflation went from a pretty tame 1.4% in 2020 all the way up to 7% by the end of 2021. And then it peaked at that stunning 9.1% in the middle of 2022. This clearly wasn't some transitory blip. No way. This was the worst inflation we had seen in 40 years. And that delay, that waiting around, that's now widely seen as the absolute core of the mistake. The consensus today is pretty clear. By waiting so long to start fighting inflation, the Fed let itself get dangerously behind the curve. And that forced them to take much more drastic measures later on. So you gotta ask, why? Why did they wait? Well, a big part of the answer might be this new policy they adopted right in 2020. It's called Flexible Average Inflation Targeting, or FAIT. The whole idea was to let inflation run hot, above their 2% target for a while to make up for all the years it was running too low. The problem is, this strategy was designed for a low-inflation world. It basically gave them permission to wait. And that's the delay that allowed inflation to just spiral out of control.
All right, Section 3, the painful correction. The fastest rate hikes in decades. And the consequence of being so far behind the curve? A painful, aggressive, and frankly, brutal correction. The Fed was forced to launch the fastest series of interest rate hikes in decades, and boy did that hit the wallets of everyday Americans, and it hit them hard.
I mean, just think about how fast this all happened. Once they finally decided, okay, inflation is a major threat, the Fed had to just slam on the economic brakes. In a little over a year, they jacked up interest rates from basically zero all the way to 5.5%. That's the highest they had been in 23 years. Just an incredible reversal. And that, of course, translated directly into pain for consumers. Let's just take mortgages, for example. The average 30-year rate went from around 2.7% in early 2021 to a peak of 7.8% by late 2023. That just absolutely crushed housing affordability for millions of people.
And it wasn't just mortgages, not by a long shot. Just look at credit card debt. It spiked by a whopping 45% in only 3 years. It soared past $1.1 trillion as families were just trying to keep up with higher prices and, of course, those rising interest rates on their balances.
Section 4, an unequal footprint, how monetary policy widens the gap. But here's something that's really important to understand. These dramatic policy swings, they don't affect everyone the same way. In fact, a growing pile of research shows they often end up making economic inequality even worse.
So when the Fed hikes rates to cool down the economy, it's the lower-income workers who get hit the hardest. Research is pretty clear on this. The biggest hit to real earnings, what your money can actually buy, is felt by the bottom 10%. Meanwhile, the top 10%, they're often more insulated. They might even benefit, earning higher interest on all their savings and investments.
This unequal impact is leading to a pretty loud and growing call for the Fed to start paying way more attention to these effects. You have organizations like Equitable Growth arguing that, hey, even if fighting inequality isn't technically in the Fed's job description, they still need to understand it. Why? Because it's absolutely critical to making sure their policies actually work for the entire economy, not just one part of it. So after 20 years of this, of crisis followed by massive responses, we're left with a really challenging, really fundamental question. Has the Fed's whole whatever-it-takes approach, swinging wildly from massive stimulus to super aggressive tightening, has it actually become a source of the very economic instability it's supposed to prevent? That's a tough one to answer.
It's a huge question, and there's definitely no easy answer. Thanks so much for watching this deep dive with us. If you found this video valuable and you like the content, don't forget to subscribe to Finance Deep Dive. It seriously motivates us to keep posting.